we're here, everybody. How you doing? Brian here from quantlabs.net. Okay, so we're just about to go live. Real important. These are now brainstorming sessions. So what does that mean? We are basically talking among ourselves, where I've got nothing to present outside of looking for feedback or contributions on what you guys have. I'm going to shut myself up here. So basically, if you have or have not been following me, on Friday I posted this video. I'm going to just get the part here. This is part of my...
Hey, what if I gave you a credit?
These ads get to me. Anyways, this video here I've posted on Friday. This was posted on Friday, and basically it's my long short selection out of 165 categorizations, market sectors. Let me just kill that. And basically what that means is I can now have 165 trading pairs per week, per day, every time I run this particular script. This video here, it is, let me just run this little ad here.
And in this treasure map, I showed you exactly where to go.
Okay, let me just skip that. Okay, so you see this video is about 40 minutes long. I go through 10 different combinations of pairs. And basically the criteria I look for is beta, and EPS, earnings price per share. And what I'm looking for is only using current performance against benchmarks like the S&P 500. I'm also looking at the guidance. Now, here's how it works with a lot of companies is the guidance is typically from the company. When they put out every quarter their guidance on how they feel about the outlook for both their sector they operate in and how their stock performance will be over the quarter or year. Basically, the higher it is, the better. So they're going to have a stronger outlook. So the idea with that, because that's forward looking, what you're trying to do is you're trying to use that as a gauge, as a long, and then also find the weakest player within the sector of to short. So then you can use obviously both that as an opportunity to trade. Now I've gone through this through my one of my courses earlier this year I presented. Let me just pull that up. So everything I do is in Python. This is going to be part of my new analytics service, but I won't be going through the code tonight. I won't be showing code at all because obviously maybe some may know I've gotten out of the coding and technology game. So what I'm focusing on is is everything moving forward is basically doing this type of analysis that we're going to talk about. So I'll talk about that as we get closer to those dates, but I'm just trying to pull up my project here concerning that. What's it called? My brain is pretty well fried right now. My apologies. Anybody got any questions so far? At all? Okay, like I said, I'm not here to talk about my code here, but I just wanted to go over how it works. Basically, what we have here I leverage a lot off of Yahoo Finance, and just so you know, there's about if I was to do a property profile on this, there's 149 items in this folder here called data. With each of these pairs are basically the long and the short for each of the categories in Yahoo Finance. So I don't know if you noticed that, but there was 149 files in here. So what I'm saying is you've got 149 combinations of longs and shorts for each category within Yahoo. Okay, so what I've done is there can be up to 165 if there's certain metrics made available. So let me just pull one up. I don't know. Let's say a good one is gold. Let me just see here. Okay, so if you look under gold here, what you'll find here is basically what I just went on about is the very first one's the short, the last one here, the second one is the long. And in here we've got the beta, and then we also have the earnings price per share. This right now does not test the market cap, but there's a lot of issues when you watch this video. There's a big reason why I don't like stock or ETFs at all. I mean, right now is an amazing time to be playing in the markets because everything's just going crazy. And with the tests that I'm looking at, the analysis, it's like huge returns. I've got returns of, returning in at least 25, 30, 50% returns. If you looked at these videos here, or this video, you'll see some pairs returning 25 up to 50% returns. I had one combination here in the hotel sector that showed a 25% divergence of spread opening within a 24 or 2-day period. I mean, the markets are just crazy right now. So the idea here was to talk about this, and I guess if no one's looked at the data, there's no point in doing that. So what I'm looking for is, why don't we just cover one of the big comments that I got from somebody, which seems to be valid. I'm looking for people's opinion on this. If you watch the video, let me just show you what was said here. This trader, James Beach, he was invited into this conversation online. Who I don't know if he's online. Hang on here. Is he? No, I got Tony, Jonathan, and James. Okay, cool. Appreciate you guys showing up. But what this guy said is he's missing the point. Mean reversion strategy, whereby the spread is traded when there is a significant deviation from the mean in the hopes that it reverts back towards it. So if two stocks are co-integrated in the spread from a stationary process, you should short the outperforming stock and buy the underperforming stock. What you're doing in this video is essentially just a two-legged momentum strategy that partially hedges sector exposure. Not to mention that beta is a measure of relative volatility, not directionality, and so it's not a momentum strategy. It's just a random, it's just random trading. So why would a large difference in volatility between two sectors present a statistical arbitrage opportunity? It makes no sense. Okay, so anybody got any opinions on this at all, on that kind of comment that I just pointed out? Hey Brian, are these year-over-year returns, and how do you time exits or reverses on pair trades? Okay, this was you. Okay, James, how you doing? Okay, cool. We'll get to your. Let me answer Jonathan's question first. The timing or year-over-year returns. I'll be covering that next Monday. I'm just piecing together two pieces. There's going to be position management once you put on your trades for your pairs, on top of the timing. It's based upon technical analysis using simple moving averages on top of a combination of trend lines when you measure the difference between the ratio of the closing long and short pricing, and once a trend line of that has been broken, that's a position that you can put on. And then there's another set of metrics that you can use for exit. So we'll cover that over the next few weeks. James, how you doing? Okay, so I like these types of discussions. Anybody got any other opinion on this particular comment from James at all, based upon what I presented? James, have you looked at the data that I've presented? That was made available here. So that data is a true reflection of these generated pairs of interest, and I try to go through a manual process to so you could download the data right here. So there's a zip file, which is basically a zip file of this folder that you're looking at here. So I can put that in the chat box if you want. Only from the video, not downloaded. Okay, James, are you able to go on audio? I think, because I'm very interested in understand. I think I understand what you're saying. No, my mic is broken. Sorry. Okay, no problem. Okay, the idea here of what I'm trying to do probably different as a definition of what you're defining as pair trading and arbitrage. All I'm trying to do is trying to when a pair crosses as an opportunity, you're trading on that spread. And what you're trying to do is you're trying to maximize as it diverges to maximize that opportunity. It's a simple concept. I don't know. That's what I mean, maybe there's different definitions of pair trading. I understand your concept. The question is, are you an experienced trader yourself, James? And how are your trades performing as you've described in your YouTube video? So just let me know how that strategy is playing out for you. Are you implementing that at all? I work at a small quant fund and we trade arbitrage strategies. Okay, so I get that, but are you trading exactly, or are you trading this as you're explaining it in this comment? Because okay, you are. How does that perform overall? 30% per year, annum. And are you analyzing, similar to what I'm doing, the different sectors as I'm doing? And so what you're basically doing is you're analyzing each sector, I'm guessing in an automated fashion, similar to what I'm doing. Question is, what sort? This is the key here. What's the sort of metrics that you use to pick off that you think which sectors are going to be over the next month to 3 months are going to be the most optimal sectors to trade in? How do you do that? That's the question. Okay. Yes. Hey, how are you? Okay, James. Yes, are all automated. We don't test which sector. We just find highly Okay, so co-integration. I guess the question is, what methodology are you using? Like Engel and Granger, what's the other one? Johansson? I mean, it doesn't really matter. But okay, it's proprietary, no problem. So the question is, if you now, okay, so if you're scanning the market, however you're doing it, if you're, I'm just gonna have to hang on here. So if you're analyzing the markets in real time, I'm assuming daily, however you do it, and you see something that's co-integrated, how do you know you're not getting into where the opportunity is just about to open up? So meaning that you're at that low point on the spread. Because I mean, the way I see it, it's you're dynamically looking at a pair. Hang on, Adam. I'm just gonna have to. Yeah, here. Just gonna mute you, Adam. Yeah. Sorry, Adam. Okay, so just let me know when you want to get unmuted, Adam. Okay, so what I'm referring to here, James, is I'm trying to understand is when you were scanning the markets for your co-integrated stocks, how do you know that is at the lowest opportunity on the spread when you do the comparison between the two, in terms of like in a ratio to measure the spread? Because at that point it could be at its peak, and are you just at that point marking it off, and then if it's marked off as co-integrated, then you start trading it right away? And at what point do you use to measure that maximum divergence in the spread? If that makes sense, what I'm trying to say. I'm just trying to learn here how you're doing it. Okay, so well, you never know for sure, but co-integration is a pretty strong relationship. So once it hits 2 standard, you can pretty well sure it will revert. So you're using standard 2 deviation. Now, how do you show that? Is that just pure statistics on the moves of the market overall, historically? From the mean, okay. How often are you doing this measurement? How often are you doing the scans? Like daily? Are you doing it intraday? Every minute. And how long are the positions normally held for? Just on average. Okay, so you're doing intraday. Would you define yourself as a HFT shop? High frequency at all? No, okay. Anybody else got any comments on this? Here, I'll show you what I'm trying to do conceptually. Okay, let me just load up Yahoo Finance. So let's say for my case, we choose a classic Coke and Pepsi. Okay. So I'll pull up Pepsi. All right. So if I do what I did in the video, comparison on an interactive chart. Okay. So if I'm looking for Coke, where are you, Coke? Okay, so here we are. So, okay, so what we have here, let's say what we got in green is, so we have here green, Coke, blue, Pepsi. So here's where I'm going to go in. At this cross here, this will be the short, let's say, on Coke, and then Pepsi. So I'll have a number of indicators running, and maybe at this point I might mark it off as maximum divergence on the spread. So I'd exit that trade. Does that make sense what I'm doing? Just want to make sure we're on the same page here. Okay, so James, we're looking for places where the spread the greatest, which is around, that's where we enter. Okay, so you're doing the opposite of what I'm doing. Right, okay, I see what you're saying. So you say, oh, I see. So you're kind of doing everything what I'm doing, but backwards. So you would short Coke and then you would long Pepsi. Is that correct? No, you would short Coke and you would, so Coke in my concept would be, I see what you're doing. Yeah, okay, so you're doing the opposite. Very good. Okay, so I'm doing it at this point, getting out here, but you guys are going in at the opposite. Right. Okay, that makes sense. But here's the question: how, like in this case, they're not converging at all until you get to, when is it? They're not even converging at all. You know what I'm saying? So do you have a lot of instances at all? They do a little bit. Okay, it depends on what time frame you look at. Okay. Well, even if I was to, let's say I was to bring up a an intraday chart. Let's say a minute. Okay, so here we are. I think this is, oh, sorry, that's 3 month. My apologies. So let's look at a 1 day. So here is probably when I'd go in, but you'd say you'd long Coke. Yeah, okay, so I'm looking at intraday right now. So you'd long Coke in green, short Pepsi. Okay, so the trade starts to progress, but yet you still wait. Like even in the same session, nothing hasn't converged yet. So I guess the question is, how do you know when you put your trade in here, as you said, long Coke, short Pepsi, how can you guarantee? But they're definitely not, oh, I see what you're saying, they're not co-integrated. Okay. Do you have any examples that you have recently that are co-integrated? Are you allowed to publicize that? I mean, I could probably run it. We use a data mining operation to find which time frame they co-integrated on. Okay. No, I understand. I mean, I can load up my I should have preloaded up my IQ feed because I have IQ feed running now on my on this system. Should have thought of that. So you test billions of combinations to find a co-integrated pair, really, eh? Do you just do the S&P 500, or do you do, let's say in my case, I've tested where I have 14,000 stocks on like what Yahoo Finance tracks. So out of that set, how many would you track or test those combinations? If you have 14,000, my requirements are, like I said, so here, this is my requirement, the beta and the EPS. So as I said in my video, you can have 11,000, and then either, if the company's reporting an EPS guidance, and there's beta also tracked, that whittle it down to about 3,000 to 4,000. So for you, James, how many companies or stocks are you tracking out of that, let's say 13 or 14,000? Because a lot of those are probably pretty crappy because, we only look at the top few hundred. So you are doing something like the S&P 500 then. And you follow the same process with FX as well? Interesting. So you're doing the same process, but you're doing the opposite of what I'm doing. Anybody got any questions on this? I think that's quite fascinating. Does your group do pairwise or high order testing for this? Good question. Jonathan, jump in whenever you want via voice. That's what pairs trading is, mean reversion. Okay. Jonathan, pairwise and higher order. Okay. If you guys want to chime in by a voice, either one of you, anytime, this is what we want. Order is difficult to transaction costs. Okay. Anybody else got any questions or comments for James? He's a live trader from a small quant fund. So let me ask you, like in this market where the markets are going up like crazy and hitting highs and new records, out of the scans that you do, like what are the percentage that you find that are co-integrated? Like 1-2%? So James, let me ask you this. Okay, we test about 1 billion a day and about 150 or okay, so you're not even at, I wouldn't even do the math, but it's very low probability, eh? So you can have, do you also track like penny stocks as well? Right, I forgot about that. Large cap. Okay. Yeah. S&P 500. Right, exactly. That's why I use the market cap. What's your minimum market cap that you want? Is it, or just let's say the S&P 500? Everybody hates, only the pariah trade penny stock. Mean reversion. Here, Adam, let me get you in there. Hey, Adam. Go ahead, Adam.
Yeah.
Yeah, sorry, man.
No, I was referring to mean reversion being similar to a correction because it normalizes back to its original trend.
Yeah. I mean, from your perspective, Adam, this is what he's doing. I know you joined late, but so he's saying, yep, pairs trading is always mean reverting. But I mean, did you hear how I'm doing it, Adam, at all?
Yeah, kind of.
Now, when you look at,
kind of, I heard you.
if you look at James' method versus like what I'm doing, I mean, what do you think the odds are where there's going to be more pair trading opportunities? So James saying the math doesn't work. So if I do a 1 year, let's say, yeah, like 1 year chart. So what I'm doing is, go ahead. Go ahead, Adam.
No, I'm listening.
Okay, he's saying this sounds like a good testable hypothesis. So for you, Jonathan, are you referring to James' methodology? Because, yeah, I agree. But I was just going to say for James' method, I think his is very valid as well. But that's when the market may, but remember, he's doing a different time frequency as well. But it's kind of like if you've looked at Tim Sykes' penny stocks. What he does, he trades on both ends of the trade opportunity. What he'll do is he'll look for the stock where it'll go into this. I can't remember what the term he calls it, like the stellar growth when the promoters start hyping the stock. And then he'll run that trade up. And then what he'll do is he'll flip the trade and then start to short it once he finds the opportunity is going to obviously go back down once the promoters are done hyping. Yeah, supernova. Thanks, Jonathan. Yeah, it'll go in this supernova state, and then he will turn around and short it. I mean, you could kind of do this with this type of trade, both with what I'm doing and also James, because you just flip the trade. Like you close out the pair that I'm analyzing, and then all you do is just reverse it, and then long the old short and short the new long. I think that would make sense because now you're doubling your opportunity in the same trade. I think that's pretty smart to do that. I think that's a really different sort of trading, but you're both right. I don't think Brian's strat is 100% market neutral, but does have some hedge against sector risk. That's right. Sort of like a trade, sort of like a hedge. Yeah, but with what I'm doing as well is that you can cross, you can trade against across different sectors as well. And as I move into it, it's a momentum strategy, not a typical pairs trading. That's fair. That's fair. I guess my terminology may be wrong, as I said earlier. Different definitions of it. But at the end of the day, part of it is to expand. Let's say if I'm shorting GM and Ford, Jonathan says, I like it because you don't short the stronger pick. Yeah. Well, this is what I'm trying to find out, because I think these are two different strategies, but from what I'm learning here, you could reverse that trade, as I said. Thing is that troubles me with your method, Brian, is how do you actually get an entry signal? Well, that's easy. I'm using, as I said earlier, I'm using technicals of both simple moving average on top of the trend line as well. So I'll do a ratio between the two closing prices, do a ratio, at the same time do a trend line, and once that ratio breaks trend, then you go in. So you don't look at the spread of when you enter the trade. Yes, you are analyzing it. You analyze it all the time, but it may not open up. It's a formation of a trading idea. So you watch it for a certain amount of time. But again, my horizon is totally different from yours. Mine's like a 1 month to a 90-day position hold. So what you're doing is totally different. Like you're doing basically intraday trading. If you're in for a couple minutes to a couple hours, momentum works better in higher time frequencies. Right. Yeah. So I'm saying 30 to 90 days. Anybody else got any questions or comments on it? I like James' strategy as well, but the question is, I mean, yes, it is co-integrated, but I mean, I'm looking at that intraday. At what point, how do you know that they diverge as well? That's what I'm kind of wondering, because they do cross, and then here we are all day, but yet I don't know if it diverges. And then here in this session, oh right, I keep forgetting that. I got a bad memory. I'm sorry, James. I'm just looking for anybody that has a co-integrated trade that we could look at. Is there a way we could find out? I don't know, but I find it an interesting. So what you're saying, James, every trade that you find that's co-integratable is it's almost 100% guarantee that within the same time period you can profit. To be honest, I don't even chart them, so I've never seen one that we trade. Well, about 70%. Okay, that's fair enough. I'm just trying to understand the historical trading pattern on that. Statistically, that is. I'm not saying that it doesn't work, but it's a bit of a risk if it doesn't, because then you're going into an overnight position. If you close out, you're gonna obviously lose. For us new people, what is the definition of co-integrated in trading? We have a very tight exit mechanisms. Lose a little sometimes is okay. Okay. Well, if you're saying you have a 70% potential win ratio, that's pretty damn good. And again, it just depends upon your exit, what your metrics are. Does anybody know a way to find a co-integratable pair like that's current? Losing is the cost of business. Yes, but if you lose too much, you're going to be out of business. So, let me just see if there's a way to find out. Co-integratable stock pairs, I guess. Let's see what we can get. I don't think there's any site that measures it. Because I remember I see these all the time, but I just don't remember them. And again, they won't be stocks anyways. I'm gonna do some analysis on your strategy there, James. Are you at liberty to talk about your exit conditions? Oh, okay. Here's one that James has given us. Yeah, give me spread. Some lose. Spread will look like this. Okay. Yeah. Do you use a trend line to as an indicator to entry and exit? Because I have a chart that does that. No, just or standard deviation. Okay, so you're using standard deviation. That's fair enough. I'm no offense. I'm going to be, well, no offense. Be honored because I'm going to make notes of these. Okay, so you're using standard deviation of 2, right? Is that all you're using? Is standard deviation 2? Looks back towards the mean, not always 2. Okay, so you have it set dynamically. Okay, what are you at liberty to talk about any of the other strategies or indicators that you use, parameters? I guess most of them are using some form of distribution analysis. Right, a lot of companies won't use stop loss. Time-based exit, meaning time-based exit. That can mean a lot of things. What are you, the spread? Okay, so there you go. It's an OU process. Okay, yeah, that's a pretty classic calculation. So you can compute the first passage of time. Okay. Okay. Once the time has elapsed, you know the trade has broken down. Okay, I'll have to do some analysis on how you mean by that. Anybody else got any comments on that? I think this is good. So, on your exit, what are you using outside of standard deviation? Anything else, or is it? I guess it's going to be all. So you said time based. Anything else at all? We exit when the spread goes near the mean. Okay, so you're using the mean as, okay, that's fair. Right. Usually 0.5 deviation away, roughly. Okay. Okay. It's pretty simple stuff. Makes sense though. And you get 70% ratio or wins out of you trading like that. And that's all you're using, or is there anything else? And you just go out and you scan dynamically. Yeah, we use GPUs to find the parameters and pairs to trade. Okay. To be honest, that would be pretty not too difficult to code up. Interesting. What do you use to... We have a NVIDIA expert here. OpenCI. So I'm going to assume that's all in C++. That's interesting. Okay, so I'm just making notes here as we go. algo to search or which mathematical approach? Okay. I think I've seen this from QuantStart. Is he using GPU? Oh, let me find out. Brute force on all the pairs. Wow. So you have no way to cut down that time, eh? And this is all done in real time, eh? No, not real time. So how far back do you back test? Oh, so, and that's using what type of data? That's 1 minute? Or how frequent's the data on the back testing? Tick data. So you're essentially, are you using some kind of like a database as well, in some form of historical patterns as well, or are you using or making any reference to that? It's all historical patterns. I see. No fundamentals. So are you familiar with the ABC pattern, James? Let me pull it up. We had a guy named, forget his name, ABC, Suri Dadella. He is the guy who came up with this, I believe. Suri Dadella, chart pattern. He's got a couple of books out on chart patterns. I don't know, I'm pretty sure this won't apply. But one of his methodologies is using called the ABC pattern. It's pretty good. I've tested it. I'm just giving you some interest if you're interested in it. The patterns we trade are very subtle. Okay. Because he's got a whole book and he's got about 65 charting patterns. ABC is the one that's universal for most of those patterns. So it's an interesting concept he's got. 10,000 strategies, time series based. No problem, James. 10,000? So you're using 10,000 patterns? Is that what you're saying? If it's historical, okay. 10,000 patterns. And what do you, so is that 10,000 patterns that you mathematically have calculated? And then that is what you're using in brute force for your GPU to test to see what's conegradable. So you've back tested these. Now, and you said it goes back to 1996. Wow. And it's all tick. So these patterns that you've come up with, are these basically... I think I know what you're trying to do. Didn't ask from tick, okay. I mean, are you using the midpoint between the two? Convolution methods to search for the patterns. Yeah, we use mid for entry. What about Jonathan's question for the convolution methods? I don't even know what those are. I've heard the name, but we don't need the history lesson, but... No, we don't. We literally just test every parameter combination. And the question is this methodology that you've come up with, it sounds kind of like, I'm trying to remember, there's a piece of software that can analyze patterns mathematically, dynamically, on the fly. I'm just trying to remember the pieces, the software name. There's a methodology with it. So you're not using any third-party software to do this type of analysis using CUDA. These are your homegrown. Yeah, I realize it's expensive, so it's all homegrown. There's a piece of software that does this. I just can't remember the name of it. And what it does, it will analyze. No. It's not strategy quant. It's a mathematical piece of software that you can use. Like, for instance, maybe Jonathan can help me out here. Jonathan, I know you're a MATLAB guy. Are you familiar with system identification? It's sort of like no Chaos Hunter. I just can't remember the name. This toolbox for MathWorks. This is similar to what you're doing. What it will do is it will go out and it will identify patterns from just different time series and generate dynamic patterns and calculations. Not the toolbox, but I did lots of pattern recognition in time series. Okay, but this one will generate basically algorithms on the fly on the data it looks at. And then there's another set of algorithms that you use to optimize which algorithm on the fly that will have a higher likelihood of profit potential. Does that sound about right, James? Because this is what this does. And there's a few tools. Okay, yeah, so that's what I'm thinking. You can use stuff like learning, basis search, and search for multi-scale wavelet. Okay. Yeah, that's what I thought. It's just mathematically, I understand the high level of it. I just can't remember the name of it. There's a couple of third-party pieces of software that does this. But one of the ones that I do know that will do this sort of is the system identification. And it analyzes it 6 ways. Obviously, you can see here nonlinear, linear. It does use wavelet as well. Time series. There's about 6 different analytical types. Yes, that's the whole point of it, Adam. It does do the forecasting. It'll generate an algorithm on the fly by looking at the data. Sure, I'll definitely try to post that piece of software. Are you Windows based, James? Because it's Windows. It's I don't know how new it is. Linux for work, but we use Visual Studio for development. But your target system's on Linux? Okay, that's fair enough. Yeah, I mean, if you're using C++, I'm assuming you're using that obviously is going to be cross-platform. Yeah, I know about these pieces of software. And you got a 70%, it sounds like a 70% winning ratio, eh? Damn, Jonathan, we got another 70% winning ratio here. If you remember Charles as well, a few weeks ago. I like this, what you're doing though, James. That's right. But if you put on, let's say, 100 trades, and 70 of those trades are winners, you're doing pretty good. Goldman Sachs will cut off their right arm to hire you. Even at 50%, they'll take you on. Yeah, that's true. Well, I mean, yeah, but James, understand it all comes down to risk metrics as well. Yeah, I mean, you have to watch your drawdowns. We know that. But I mean, let's say if you're going in the market now, you're going into a top market, and let's say you put on a couple of trades, the momentum will work against you. But you have ways to analyze markets if they're gonna tank, and you can just look at. We've talked about the options. Right now, I just put up an alert like within the last hour about how the S&P Options trades right now have a lot of short positions on, so they are forecasting it should go down. And that's net short long net short positions. Does your firm have many science or math background types, or is it mostly computer science and traders? Guess that's for you, James. The guy who works with his PhD in computer computational statistics. Interesting. Yeah, I've seen a lot of these kind of strategies. Well, it depends what you define, Adam, as quants. Quants can mean a lot, but this is a form of quant, yeah.
Well, quants mean programming, mathematics, statistics, a plethora of disciplines that encompasses a quant, which allows him to create trading strategies and so forth and so on. I spoke to a few of them. So
Yeah. So it sounds like you got a good strategy there, James. That kind of winning ratio is not bad. Anybody else got any questions? Well, the thing is, with my quote-unquote pair trading, or whatever you want to call it, I'm using, here's the metrics that I'm using. Let me just pull up another document here. Right now I'm using ATR, average true range, as I said, EPS, market cap. This is all fundamental, obviously. And then, depending upon certain conditions, then we can use, like I said, trend line on the spread between the closing of the two pairs, the long and short, as well as we are also be using SMA as well. EPS makes sense, but why are you using ATR for volatility? It's basically it's a proper way to measure implied volatility, but that's where I was going to go with the close. Again, I know you questioned the beta. It's just as a form, and also some other technicals as well. As I said, moving SMA as well as trend lines on top of that as well as part of the technical analysis, and the other one is typical statistics distribution, that form. But what does the volatility got to do with the entry signal? No, what I'm talking about is here. I'm talking about implied volatility. That's on the exit. That's what I'm referring to. Yeah, so you're using implied volatility on the close. So that's what I'm looking at. Oh, thanks, James. Glad we got synchronization there. But for you, Jonathan, that's pretty well what I'm looking at. I'll put that in the chat if you want. These are just the basics for equity. I can't guarantee it. This is just how I'm starting out as, but those are the indicators that I'm using. Yeah, so we got implied volatility. Now this is the question: What else do people use? I mean, how many we got? We got five people online. Anybody else got any other things that they would use for classic arbitrage or pair trading as an indicator for both the entry or the exit? Anything you could think of, Jonathan? Or do you think we got it covered? I mean, I know there's some mathematical ones, but these are just more simple, fundamental / technical analysis. And I'm sure I'll be adding more as I get more on the mathy side. But the idea between all of this is use some form of a genetic algorithm on the exit. You can use Bollinger Bands to do the same thing as what I'm doing. Are you using Bollinger at all? No, okay. Right. So you're just using some form of an upper and lower bound. Yeah, I gotcha. Yeah. Yeah. I think Bollinger. Do you use any kind of form of RSI? Because I know Bloomberg started using a lot of the RSI for oversold and undersold. They've been doing that with the Japanese yen lately. No other indicators. Okay. WPPA. That I'm not sure what that is. I know there's WPVPA. In what context? Sorry, volume weighted price average. I see. Okay, thanks. Oh, Jonathan, man, you know a lot of stuff, man. It's pretty scary what you know for my short time. What are you using it for, Jonathan, I guess? I know about it, but I've never really used it. I've been told just to use simple moving average. For entry and exit. Few of the colleagues use it, but I don't. So they love it. Interesting. Okay. Anything else that we've been missing as part of these indicators at all? Because that's what I'm looking for. I know there's a pile, but for just specific for pairs and arbitrage. No? So what everybody's saying here is that we've covered pretty well everything out there that we can use for both pair trading and arbitrage. I like your strategy though, James. I could see on the flip side you could apply something like that on a more intraday level as you guys are. Yeah, I know, James. There's so much material out there. It's like it's hard to. I mean, it's I call it teaching the teacher. You just take something out there online and you just apply it. Are you around and to keep in touch to chat about this in the future? Yes. James, you know about our Facebook group, right? You're familiar with it? Okay, cool. Just join that and I'll get you approved and be part of the community. I think we'd be honored to have you in there just for your experience. Do you want the link? Let me pull up the link. Go for it. Okay. You like a guy that says go for it. Okay. So it's basically Facebook group, I think Quant Labs, Net, something like that. I don't have much time to be honest, but I'll try and drop if I can. Okay, well this is the group here. Well you're on YouTube as well though, right? Maybe that's a better place for you. Here's the link. Yeah, so he's on YouTube, Jonathan. If you go under this video here, you may be able to message him through YouTube if you guys want to talk privately. So right here, just under James Beach for you, Jonathan. I just put the link in there for the video that I'm referring to. That's the one that went up on Friday. So it sounds like we may have covered everything. Is there anything else you can think of, James, Jonathan, or Adam? If you message me on YouTube, then you can have my email. There you go. Good stuff. So between everybody, is there any other indicators that I've missed or parameters that we could use for pair trading or arbitrage? Or is it safe to say we've got a lot covered? We've got trend line we've talked about. We've talked about the SMA. In my case, ATR, EPS, market cap, beta, stats. You're using standard deviation with a mean. Queried about the volume weighted. There's some better moving averages than SMA. Probably. This is what I said. My Jung's JMA is very good. Okay. Or Jurek. Sorry. Okay, that's good to know. Anything else? Yeah, I'm sure there's a lot of modified moving averages out there in the military. Okay. Anything else that anyone can think of? Can throw it up there, and I can. Anybody? So we've covered quite a lot because this is the whole point, is just to cover anything else that I'm not considering for pair trading or arbitrage. So to answer your question, Jonathan, next week I'm going to do a brainstorming thing on position management, like stop losses and so on and so forth next week. So we'll cover that. Setting targets and stop losses and rolling up your stop loss. But again, these are all dynamic. Jonathan, if anyone's interested in time frequency based, I'm working on a library for GPUs. Same time next week, James. 6 p.m. How would I be able to communicate? Are you on my blog at all? Actually, are you on my email? Because I'll post that on my email newsletter thing that I send out every day. Okay, cool. So you're able to keep track then. Cool. Yeah, like I'm doing these ongoing every Monday now, except Christmas is on Mondays, so I won't be doing that. But following Mondays, I'll be doing it. Everybody's welcome as usual. Anybody else got any comments or questions? Just so you know, I've got the new dashboard up for my new service coming up on the analytics. That's going to be a pretty exciting phase, I think. It's going to involve all these strategies and the charting of it. Oh, no problem, Jonathan. I mean, I know you're part of this a lot, so I appreciate you coming out and everyone else coming out as well. I'm learning a lot. Thanks, James, for coming out and participating. I fully understand where you're coming from. I think we're just doing the opposite, and my definition is different from, I guess, yours. And thanks from New York. Yeah, exactly. There's no wrong way as long as everyone's getting some profit out of it. If it works, is right. Yeah. Anything else anybody wants to add at all? Okay. Yeah, okay. Well, I got my 8 o'clock. It's been posted in my membership, just so whoever's out there wants to know. So, anything else anyone wants to add at all? If not, we can call it a night, and thanks for coming out. I'll be posting this online. Is that okay, James? I don't want to get you into any form of problems. Just give me a yay or nay, and okay, cool. Thanks, man. It's guys like you where yeah, okay, you can blame me. That's what. Okay, if you're confident that nothing will happen. Okay. We don't want to have that happen. I thought I had a lynch mob when my my courseware access went on the blink on Saturday, but it got fixed this morning, thank God. Okay, so we're all good. Okay, anybody else wants to add anything? If not, thanks for coming out. This was a very good event. I like doing these because I learn, you learn, everybody learns, so everyone wins, and we can apply some new stuff. I do like your approach, James. On the flip as well, on the strategy, that may do well. Just make everything opposite of what you're watching. That's what I love about trading. You can trade at all angles and multiply it by 10. All the different ways to look at the markets. That's very good. I appreciate it. Anybody else got any questions or comments at all? If not, I'll do a going once, twice, 3 times, and we'll give her a wrap. Okay, so I'll do a going once, going twice, going 3 times. Okay, thanks, guys. This was awesome. No problem, guys. If you want, James and everybody else, just come on out next week to the next 6 p.m. and we'll go from there. But you guys were awesome. I appreciate it. I'm probably going to add this to the arsenal of strategy thanks to you, James. This was a good one. Very good one, actually. Okay, I'm going to shut her down. Thanks again. And have a good night, day, wherever you are. Later.